Let's look at question number 2 of June 2026 pilot paper question. So with this, actually we are starting section B of the paper, right? Section B, you have 3 questions. Out of that, in the exam, you need to answer 2 questions, 25 marks each, right? So there are a few parts in question number 2. So as usual, before reading the question, let's look at the first requirement. So what is required? Part A, evaluate the financial reporting implications of each lease arrangement, right? You have to evaluate the financial reporting implications of each lease arrangement. Seems that there are few lease arrangements under SLFRS 16 leases for the year ended 31st March 2027. So the year end is 31st March 2027. Right, by keeping that requirement in mind, now let's read the question. Mega PLC, Mega, a company operating a supermarket chain across Sri Lanka, is planning to expand its operations by opening new outlet in Northern province. So they need to open new outlets, right, in Northern province. They want to expand. Mega is currently in the process of negotiating lease agreements with landlords for 2 locations identified as strategically important under the following terms. So that means these are long-term decisions. So they are identifying strategically important locations and at the moment negotiating with so they want to enter into lease agreements and negotiating with the landlords. So there are 2 locations. Okay. So these locations are strategically important. So these are the terms that they are negotiating in terms of these 2 locations. So one is in Jaffna, right? So in terms of the Jaffna location, lease payment, the fixed component is 12 million per year paid in advance. In advance means at the beginning of the period, at the beginning of the year, you make the payment. 12 million per annum or per year. Then there's a variable component as well. In addition to the fixed lease payment, 2% of revenue generated from the outlet. Okay. So once you start the business, so by operating the supermarket, so the company generates revenue. Out of that revenue, 2% you have to pay to the landlord, right? You would become the lessee, you have to pay to the lessor, right? That is the variable component. Fixed component of 12 million per year paid in advance at the beginning of the year, and variable component is 2% of the revenue generated from the outlet. Then extension option further 10 years at the lessee's discretion. Okay, after the initial lease period, we look at what is the initial lease period in a little while, right? So there's a further extension that you can request at the lessee's discretion. That means you are the lessee in this arrangement. At your discretion, you can ask for further extension of 10 years at the end of the primary or the initial lease period. The second location is in Vaunia. So where the fixed component, the fixed payment is 8 million per year. Again, paid in advance. Both cases you make the payment in advance. Then there's a variable component as well in the second outlet as well. Inflation based adjustment per CCIP, right? Colombo Consumers Price Index. So that is the main index that you use to measure the inflation. So based on the Colombo Consumers Price Index, once the index changes, according to that, you agree a certain amount of payment to be paid as per this arrangement, right? Inflation based adjustment based on CCPI. Then extension option, again you can extend for another 10 years period after the initial lease period. But here, whose discretion? Not at your discretion, but lessor's discretion. Landlord has to agree, otherwise you can't extend the lease. Okay. So In the first case, Jaffna allocation, lessee's discretion. That means your discretion. Second one, voucher, you can extend for another 10 years, but not on your discretion, but the lessor's, landlord's discretion. Then respective lease periods without the extension option are 10 years. Okay, that means primary lease term without these extension options are for how many years? 10 years. So there's a primary lease period of 10 years. Thereafter, in both cases, you can go for an extension of 10 years, but in the first case, at lessee's discretion, second case, at lessor's discretion. Right. So let's read the rest as well. Additionally, Mega expect to incur lawyer's fee. Mega, that means company, our company, expect to incur what? Lawyer's fees equal to 1% of first year's fixed lease payment for each outlet at the time of signing the respective lease arrangements. At the time of signing. So, to prepare the lease arrangement or the agreement, you have to take the support of a lawyer. So, you have to pay the lawyer fee, which is equivalent to 1% of the first year's lease payment. Now, the first year's lease payment is how much? In case of Jaffna allocation, it was 12 million. In case of voucher allocation, it is 8 million. 1% out of this total you have to pay as the lawyer fees. Okay. That is the initial transaction cost or initial direct cost that you incur to enter into this lease arrangement. Then the lease agreements are expected to be signed on 1st April 2026. So the year end is 31st March 2027. So you are expecting to sign the lease agreements on 1st April 2026. That means at the beginning of the financial year. Right. Then examiner has given you the numbers for you to do to answer to the question, because in terms of leases, we know we need to calculate the present value of the lease payments. So examiner, actually what he has done is actually he has given you the numbers. He has calculated certain figures and given you the numbers. Then you don't need to waste time in terms of the computation. What it says is present value of variable lease components and the incremental borrowing rates at the date of signing the respective lease agreements with and without considering the extension options are as follows. Okay, what he has given is only the present value of the variable component, because there are two components here in terms of the lease, fixed component and the variable component. What he has done is he has given you the present value of the variable component only, not the fixed component, since that fixed component you need to find out. And the other thing is the present value of the variable component he has given by considering the extension option as well as without considering the extension option. Because it was mentioned that the initial or the primary lease term is for 10 years. Thereafter, you can go for another extension of 10 years. Here also the same, but whose discretion is different. So because of that, what examiner has done is he has given you what is the present value of the variable component without the extension. That means if you just consider the 10 years, what is the present value? Then with the extension, that means primary period 10 years plus another 10 years, altogether 20 years. If you consider the entire 20 years, what is the variable component? Here also the same thing. Examiner has given you variable component without considering the extension. That means if it is for 10 years, what is the value of the variable component? Then with considering the extension, which means 10 plus 10, 20 years. If it is for 20 years, what is the present value of the variable component? So all these numbers are given in the question. Right? So with regard to Jaffna, without extension option, how much? 9,720,000. That is, if you use it only for the primary lease period, initial lease period of 10 years, what is the present value? 9,720,000. with extension, that is if you go for the entire 20 years primary period plus the extension period, 10 plus 10, present value of the variable component is, this is the variable component only, present value of the variable component is 11,160,000. Similarly, in terms of the Vaunia allocation as well, so examiner has given what is the present value of the variable component without extension option, that is 10 years, and with extension option, which is 10 plus 10, 20 years. But the numbers what is given in the pilot paper is wrong, right? So those have to be changed. Now this has to be, because this is the present value for 10 years. That is how much? That has to be the lower figure. Now if you look at Jaffna, 10 years, 20 years. So the 20-year number has to be higher. Now here also, without extension means 10 years. With extension means 20 years. So that Vaunia allocation without extension, it has to be 5,163,200. With extension, that is for 20 years, it is how much? It has to be this figure. So what is the figure? 7,194,240. Right? 7,194,240. So 5,163,200, 7,194,240. Okay, right. Then, in addition to that, you have been given what is the incremental borrowing rate as well. Because when you are the lessee, we know at the inception of the lease, you have recognized the lease liability and the right of use the asset. To calculate the value of the lease liability, you need to present value the lease payments. So for that, you have to select a discounting factor. What it says is you have to select the discounting factor as the what? Implicit interest rate of the lease, right? That is lessor's IRR. So if implicit interest rate of the lease is not available, you have to use the lessee's incremental borrowing rate. So here you have been given the incremental borrowing rate of the lessee. Again, this borrowing rate is different without extension and with extension. The reason is actually because without extension means how many years? 10 years. This is 10 years. With extension means how many years? 20 years. So when you borrow for a longer period, your borrowing cost is high, right? So if you are borrowing for a shorter period, borrowing rate is less. So that's why this is 10% and this is 20%. So there's a big gap, right? Hypothetical. But normally, usually when you borrow for 10 years, you can get a better rate rather than you borrow for 20 years. So according to the question, incremental borrowing rate without the extension option, that is if it is for 10 years, 10%. With extension option, if that is for 10 plus 10, 20 years, 20%, right? Then it is assumed that inflation rate will remain same throughout the year ending 31st March 2027. Right, inflation rate has not been changed, right? So at the beginning of the year as well as during the year, it has been constant. Okay, so I'll explain why that is given, right, when I answer to the question. Then building in Jaffna requires significant modifications costing 100 million rupees. As a result, it is expected that it will take an additional 6 months to open the outlet from the date of signing the lease agreement, right? So there are 2 locations now. Out of that, building in Jaffna requires what? Significant modification. You have to incur additional cost after entering into the lease. You have to incur additional cost of 100 million to modify the building to make it ready to operate as a supermarket. So because of that, there will be a delay in starting the actual operations because this modification work would require some time. So as a result, it is expected that it will take additional 6 months to open the outlet from the date of signing the lease agreement. So the Vaunia location, you can start the operations as soon as you sign the lease agreement. But JEFNA, as there's significant modification requires, from the signing date, you actually operate or you will start the operations in 6 months' time. Right. So this is what is there in the question. So we looked at the requirement. Requirement is to evaluate the financial reporting implications of the each lease agreements under SL-FRS 16 leases for the year ended 31st March 2027. Right. So you have to account this from lessee's perspective. We know as per SL-FRS 16 leases. So if you are the lessee, what you do is you have recognized the lease liability and the right of use asset at the inception of the lease. So out of these two, first of all, you decide what is the value of the lease liability. What is the value of the lease liability? When you want to assess the value of the lease liability, there are a few things that you need to consider. That is, one is actually you have to decide what is your lease term. Okay, what is your lease term? Now, because this case, initial lease period is 10 years. Thereafter, you have an extension option in both of these locations. In that case, are you taking this extension period into the lease term or not? Or in other words, whether the lease term is 10 years or else whether the lease term is 10 plus 10, 20 years. So both these locations, you have to decide that what is the lease term is. Right? That is number one. Thereafter, you need to identify what are the, now to, you have recognized the lease liability, no? So when you want to recognize the lease liability, you have to take the present value of the lease payments. Now when you are taking the present value of the lease payments, now there are two components here. There are fixed components and there are variable components. Are you going to take both these things into the computation of lease liability? Are you taking the fixed component as well as the variable component? Or else are you going to take only fixed component? You have to decide. Right? Then thereafter, now after you decide, these are the lease terms, this is my lease term, and these are the lease payments that I'm going to take into the computation of the present value of the lease liability. Thereafter, you have to decide the discounting factor. What is the discounting factor that I'm going to take? Now, in this case, you have to take the implicit interest rate of the lease is not given, so that you have to use the incremental borrowing rate. Now, when it comes to the incremental borrowing rate, there are two rates, 10% and 20%. So, which one am I going to select? That depends on what? Your lease term, no? Whether the lease term is 10 years, if so, 10%. If the lease term is 20 years, 20%. Right? What is the lease term? According to the lease term, what is the incremental borrowing rate that I am going to use? Right? Then, when you are deciding the lease term, I told you, are you going to take the extension into account or not? Plus, you also need to know that what are the cash flows that I'm going to take into the computation of the present value of the lease liability. Am I going to take the fixed plus variable or am I going to take fixed only, depending on the situation? So by taking all these things into account, now I need to answer to the question. So these are things that you need to consider. By looking at these things, we need to value the present value of the lease liability. So we discussed similar type of questions in the class, right? So this is basically, if I show you, this is actually the theory to it, what you have been given, right? So this is what I mentioned. At the inception of the lease, lessee has to recognize the lease liability and the right of use the asset. And when it comes to the value of the lease liability, right? When it comes to the value of the lease liability, so these are the things which are included. So I told you we need to decide what are the components that I'm going to take into the lease, right? So these are the components that you need to consider. And thereafter, when you are assessing the value of the right of use the asset, you first of all calculate the value of the lease liability and to that you make certain adjustments and derive what is the right of use the asset. Okay, so I'll come there, but before that, let me go to this particular area of deciding the lease term. Now, when you are deciding the lease term, you have to first of all take the non-cancelable period. In this case, what is the non-cancelable period? Oh, this is actually the primary period, initial period, 10 years. There's no doubt on the 10 years. Okay, now from lessee's perspective, we are going to decide what is the lease term, right? It is, so first of all, the primary period, non-cancelable period. Then period covered by an option to extend the lease if reasonably certain that to be exercised. What does that mean? Now, if I go back to your question, what we're discussing, with regard to Jaffna location, now I need to decide whether I am going to take the extension period or not. That depends on whether it is reasonably certain. I am the lessee, no? Whether it is reasonably certain that I am going to take this extension. What do you say? Is it reasonably certain or not? First of all, who has the discretion? You have the discretion. Okay, so the lessee, that means you can make the decision. You are the one who is going to make the decision. And is it reasonably certain? Based on the information what is given over here, because if you look at the Jaffna location, what you do? You are going to make a modification which cost you 100 million. Do you think that after spending 100 million, lessee will continue only for the 10 years? No, definitely. Why he incur this much of money? Because he's investing for long term. So he definitely want to go for the what? Extension period as well. Okay, so it is reasonably certain that lessee will extend the lease for the extension period. Because why? Two things. One is, it is in lessee's discretion, your discretion. You are the one who is going to make the decision. Plus, you invest this money, huge amount. Then after investing, it is reasonably certain that you will extend the lease for the next 10 years as well to get the economic benefit out of that. So because of that, in case of the Jaffna location, I can say that my lease term is for how many years? 20 years. 10 plus 10, my lease term is 20 years. Are we clear? What about Vaunia? What about Vaunia? Same situation, primary lease period, initial lease period is for 10 years and there's an extension for another 10 years. Here, extension is in whose discretion? Not lessee's discretion. I am answering this question from lessee's point of view. Your company, our company is lessee. But here, who has the discretion? Lessor has the discretion. I don't have any control over that decision. So in that case, can I consider the extension period? No, I can't. I can't consider the secondary period. I have to stick only for the primary period. So because of that, in the second case, what is your lease term? 10 years. So now you see, in two leases, what you have here, the lease term is different. 20 years in case of Jaffna property and 10 years in case of what? Vaunia property. Then the other thing is, when your lease term is different, incremental borrowing cost, the rate that you are going to use is also different. If it is 20 years, what is the rate? 20%. Now in case of Jaffna property, what is the lease term? In case of the Jaffna property, what is the lease term? 20 years. Then what has to be the incremental borrowing rate that you need to use? 20%. In case of 𝐻𝐽𝐼 property, lease term is 10 years. Then incremental borrowing rate has to be 10%. Are we clear with that aspect as well? Right. Now we decided lease term as well as the incremental borrowing rate or the discounting rate that you're going to use based on the lease term. That is clear. Then I'm going to calculate the value of the lease liability, present value of the lease payments. Now lease payments includes number of things. Now let's look at what you need to include within the lease payments. Recognize the present value of the lease payments payable over the lease term. Now we know the lease term of each of the lease. Lease payments includes, right. So there are 5 things here. Out of these 5 things, all things are not applicable to this question. So I'm going to take only the ones which are relevant. I don't have time to discuss entire theory. If you can't remember, what you can do is go and refer the what you call the lecture or else the tutorial where you can understand the full theory, right? So first of all, it includes what? It includes what? Fixed payment. Now both these leases, you have what? Fixed payment, no? In both these leases, you have fixed payment. So that has to be taken, right? Then variable payments. In both cases, we had variable payments as well. Now, when you are taking the variable payments, you need to be careful. Why? When it comes to variable payment valued at the inception based on the index or rate at the lease commencement date, you can't consider all types of variable payments. So the variable payments are limited to 2 things. One is these variable payments are based on an index. In this case, in one situation, property which is in 𝐻𝐽𝐼 property, the lease payments or the variable lease payments are depending on what? Colombo Consumer Price Index, depending on an index. So depending on the value of the index, if the index goes up, you have to pay more. If the index comes down, you have to pay less. So that vary. That has to be considered as a part of the present value of the lease liability component because that variable payment is depending on an index. Other one is depending on a rate. Rate means what? You agree at the inception, every year variable lease payments are getting increased by 5%. So each year there will be a 5% increase. So that is what? The amount vary depending on a what? Not depending on an index, but depending on a particular rate. So that is also considered as a part of variable payment, or that is included into the computation of the lease liability, present value of the lease liability computation. Now the question is, in terms of the Jaffna property, we discussed about the 𝐻𝐽𝐼 property that is depending on the Colombo Consumer Price Index. So that can be considered as a part of the liability computation, present value of the lease liability computation. My question to you is, can we consider the variable lease payments of the Jaffna property? That is depending on the what? Percentage of revenue, isn't it? That is what? Percentage of revenue. %2 of revenue generated from the outlet. Outlet revenue in Jaffna, that particular outlet revenue, out of that, lessee has to pay how much? 2%. Is it depending on an index? No. Is it a particular rate increment each year? No. This is something depending on the revenue. Revenue can go up or down. Out of that, you need to pay 2%. So that is not getting counted under this particular definition, right? Because variable payments are included only if it is an index or else rate increase or rate change each and every year. So there should be a particular rate, 5% increase. Okay, it can be 5% increase per annum or 5% increase in every 2 years. But this one is not that. No. Depending on the revenue, percentage of revenue is not going to be counted under this definition. So that variable payments that you are going to make under the Jaffna outlet, that's not going to be taken into the computation of the present value of the lease liability. Is that understood? Is that understood? Right? Then you might have a question, okay, what I'm going to do with that? These payments that I'm going to pay, 2% of revenue each year. I'm not going to take into the lease liability computation, fine, then what I'm going to do? When you make the payment, okay, in each year you know how much you need to pay now. You know the revenue, then out of that you take 2%, that amount you expense the P&L. You charge the P&L. Only thing is you can't take that into the computation of the present value of the lease liability. I hope you understood about it. Okay. Right. Then third point is not relevant here. That's why I said that I'm not going to explain everything. Then the fourth point is relevant. Okay, that also not exactly the same thing, because what it says is option to purchase that are reasonably certain to be exercised. I'm not going to purchase any of these outlets, right? But remember, when we are discussing the lease term, we discussed in case of Jaffna property, your lease term is for how many years? 20 years. In case of 𝐒𝐫𝐚𝐽𝐼𝐻 property, we decided your lease term is 10 years. So in case of the Jaffna property, then you have to consider the payments. Now in case of Jaffna property, if you look at over here, in case of the Jaffna property, you have to, when you are computing the present value of the lease liability, right? When you are computing the present value of the lease liability, Jaffna property, you have to take 20 years into account. You consider the fixed payment. Fixed payments are anyway considered. You are not going to consider the variable payments into the present value of the lease liability computation. So the variable payments are expensed in the relevant year to the P&L. Right? On the other hand, in case of the 𝐒𝐫𝐚𝐽𝐼𝐻 location, so your lease term is 10 years. Fixed payment is anyway considered, as well as in this case you consider the variable lease payments are as well, because why? It is based on the index CCPN. So I already explained to you, depending on the lease term, your incremental borrowing rate is different. 10 years 10%, 20 years 20%. Right? So shall we look at how to compute the value of the lease liability? Right? So we have the suggested answer. So in the suggested answer, I'll straight away move into the or else, as is this is important, SL-FRS 16 is an important standard. Let's quickly go through what is there. Okay. So you anyway need to go through, no? Right? Approach note, how to approach the question. For the lease arrangements, apply SL-FRS 16 by first identifying the lease term, distinguishing fixed and the variable lease payments, and assessing the impact of extension option based on whether they are reasonably certain to be exercised. All things what we discussed. Determine the initial measurement of the lease liabilities and the right of use the asset, ensuring that initial direct cost and the advance payment are treated appropriately, and consider subsequent measurement implications. That I will discuss when I am discussing about the right of use the asset. right? Sure. Then, as paragraph 22 of SLFRS 16, you don't need to remember the paragraph numbers. At the date of commencement of each lease, MEGA should recognize the right of use asset and the corresponding liability. At the inception of the lease, you had recognized the lease liability and the right of use the asset. So first of all, out of these two, what you calculate is the value of the lease liability. Thereafter, only based on that, you derive the right of use asset. First of all, the lease liability, thereafter the right of use asset. Both has to be computed at the inception of the lease, in this situation, 1st April 2026. Based on the terms which are expected to be agreed with the landlords, following financial implications will result from each of the contract. Right, Jaffna. At the date of commencement of the lease contract, a lease liability need to be recognized at the present value of unpaid future lease payments of 12 million to be paid over the lease period. So I told you, you have to take the fixed payments, right? You have to take the fixed payments. When I do come to the computation, there's another point I need to explain, because in this lease arrangement, lease payments are paid in what? In advance, at the beginning of the year. That means first year lease payment is paid at the commencement date. So remember that point to account, but once I move to the computation, I'll explain that point, right? So for the time being, remember Jaffna property. So you have to take the unpaid to the computation of the lease liability. You have to take the unpaid future lease payments of 12 million over the lease term. Now, what is the lease term of Jaffna property? We decided 20 years. Right? Now, during this 20 years period, you pay this fixed amount of 12 million at the beginning of each year. At the beginning of each year. Now, the first year payment is already paid on the commencement date or not? It is paid on the commencement. It is paid on the commencement. Then, when you are computing, right, when you are computing the present value of the lease liability, right? Now, if I put this into a timeline for you to understand clear, say this is the lease term. There's initial period of 10, and we consider the extension period as well into the lease term of Jaffna property, which we discussed, 20. Right? Right. Let's assume this is 10-year period. Okay. Similarly, right, 11, 12, 13, 14, 15, 16. Right. So this is my lease term now. When it comes to the lease payments, if examiner is silent on the date of the payment, normally the lease payments are made in arrears. In arrears means at the end of the year. If he is silent, it is in arrears. But normally examiner mention whether it is in arrears or in advance. In this case, what? In advance. That means 20-year lease payment, the first payment is made at the beginning of the first year. At the beginning of the first year means what? Year 0 itself, no? Over here. Year 0 itself. Beginning of the first year means what? Year 0. It is paid. So thereafter, each year you make the payment at the beginning of each year. So that means when it comes to year 2 payment, where do you pay? beginning of year 2. Beginning of year 2 means what? Year 1. Third year, beginning of year 3. That means at the end of year 2. Beginning of year 2 means at the end of year 1. Beginning of year 3 means what? At the end of year 2. So likewise, you need to make the payments at the beginning of each year. And in this instance, when do we make the last payment? When do we make the last payment? Beginning of year 20. Beginning of year 20 means at the end of year 19. Right? This is the pattern. Now, out of that, you are computing the present value of the lease liability at inception, 0. When it comes to the inception date, the first payment, that is for the first year, is already paid. Right? If it is already paid, are you going to take that into the computation of the liability? Because liability means what you have not paid. Present value of the remaining lease period. So remember, when you are computing the fixed component, 12 million each per annum, you have to take into the liability computation only 19 payments. Okay, so you have to take it only for 19 payments because the first one is already paid at the beginning of year 1. Is that clear with you? I hope you understood about it. Okay, right. Now if I go back, if I go back to the computation, okay, somewhere over here, right. So if I read it, at the commencement of the lease contract, lease liability need to be recognized at the present value of the unpaid. Present value of the what? Unpaid future lease payments of 12 million. That means you just have only 19 payments more to be paid over the lease term. However, as per paragraph 27 of SL-25-1 16, the variable payments are not dependent. Variable payments which are not dependent on an index or rate cannot be considered. So that's why in Jaffna property, we are not going to take it. Okay, because that is a percentage of revenue that's not getting counted to the computation of the lease liability. Cannot be considered as part of the lease liability. Accordingly, variable payments which are to be paid based on the revenue of the outlet cannot be considered as a part of lease liability. For paragraph 38b, the variable payments should be recognized in the relevant year profit and loss account. When you incur that expenditure for that particular year, you recognize that into the P&L. Don't take into the liability computation. Still, we are talking about the Jaffna property. Then about the lease term, in the determination of the lease period, extension option of 10 years should also be considered. It has to be considered here. As due to the why? It is reasonably certain that this lease would be extended and go for the secondary period. Two reasons. One is lessee has the discretion. Lessee is the one who is going to make the decision. So you have the control over the decision. Plus, you incur a significant amount of modification cost, 100 million. By incurring 100 million, there's no reason for you not to go for the extension period. As due to the significant modification cost incurred and the strategic importance of the location. And also it's mentioned in the question, these locations are strategically important. So because of that, you don't want to stop at the end of the primary period. You will definitely go for the what? Secondary period as well. What it says is, in the determination of the lease period, the extension option of 10 years should also be considered due to the significant modification of the cost incurred and the strategic importance of the location. It is reasonably certain that lessee will exercise the extension option. So the lease term is for how many years then? In case of Jaffna location, 20 years that we have already discussed. Then if the lease term is for 20 years, what is the incremental borrowing rate? Incremental borrowing rate to be considered is 20%, as the extension option is also included into the lease period. Right. %20. Accordingly, lease liability at the commencement of the lease should be computed as follows. Right. So you have to calculate the present value of the fixed lease payments. Now, how to calculate the present value? You have to take the annuity factor. Annuity factor means what? You pay the same amount. How many remaining payments I already discussed? Only 19 payments are pending. So you have to calculate what is the present value of these 19 payments, because the first payment is already paid. Don't take that into the liability computation. Present value of these 19 payments, 12 million each. So you have to calculate the annuity factor. Okay, annuity factor for how many years? Now this is the annuity formula. Okay, this is the formula. Right? So what is R here? Okay, you can apply this formula and get this number. What is R? R is discount rate, incremental borrowing rate, 20%. N, how many years to go? How many lease periods? How many payments are pending? So here you need to be careful, 19. Don't take it as 20. Yeah? Okay, that's why I draw the timeline for you to understand this. Right? That's why I draw the timeline. Now look at what you look at is the lease payments. Right? Now the first one is paid. You can't consider that into the lease liability computation. Now look at, if you look at the payments at the inception mean time period 0. So once you exclude the first payment, what is already paid, not going to be taken to the liability computation, how many remaining payments are to be paid? 19 payments. Right? So you are going to compute the present value of these 19 payments. Right? Present value of these 19 payments. So if you look at now, when you add time period 0, the first payment would happen at the beginning of year 2. At the beginning of year 2 means what? At the end of year 1. Last payment would be at the beginning of year 20. Beginning of year 20 means 19. At the end of year 19. So by applying this particular annuity formula, discounting rate is 20%, 19 periods. So what is the value that you get? This is the value that you get. 4.8435. 4.8435. That is the annuity factor for 19 years at 20%. So you multiply that annuity factor by 12 million. Then you get the present value of the lease payments, fixed lease payments, 58,121,948. Because in Jaffna property, remember, we are not going to take the variable component into the lease liability computation, as it is percentage of revenue. So then value of the lease liability is what? 58,121,948. Are we clear? Now we have computed the lease liability value at the inception for Jaffna property. Are we clear? Right. Then in terms of the 𝐒𝐿𝐼 property, you have to do the same here, but the computation is different. The same methodology, but the computation is different because lease term is different. And here you consider the fixed component as well as the variable component, because variable component is depending on an index. So by taking those into account, we need to compute the present value of the lease liability of the 𝐒𝐿𝐼 property as well. At the commencement of the lease contract, the lease liability should be recognized at the present value of unpaid. Again unpaid. Because here also payments are made in advance. That means first payment is paid. Unpaid fixed lease payments of 8 million over the lease period. Now here what is the lease term? We decided lease term is only for 10 years. Because it's not reasonably certain that extension would be continued. Because the reason is who has the discretion? Who has the discretion? Who can make the decision? Lessor has to make the decision. It is extendable at lessor's discretion. So then lessee can't say that it is reasonably certain that you go for the extension period. So because of that we limited the lease term for 10 years. So when computing the lease liability, you have to take the unpaid fixed lease components 8 million per year over the lease period. In addition to that, you also need to take the what? Variable lease payments into account when computing the value of the lease liability. As the variable payment is based on an inflation rate, right? CCPI. CCPI means Colombo Consumer Price Index. So that measures the inflation. As paragraph 27 of SLFRS 16, it should be included in the determination of the lease liability. Right? So in this case, variable lease payments. Variable lease payments are included. Should be included in the determination of the lease liability at the rate prevailing at the lease commencement date. Now, we know that variable component or the variable payment is depending on an index, CCPI. CCPI. Okay, it's an inflation-based adjustment. Now, what I'm asking is, lease term is for 10 years. Now, over this 10-year period, what can happen is CCPI. This index can be changed. Inflation rate can be changed. This year inflation, according to the question, it's mentioned that current year, for the year ended 31st March 2027, there's no inflation. But it can be anything. It can be 2%, it can be 5%. Right? So, now the question is, when you are computing the present value of the lease liability, you have to put some numbers for each of these payments, right? Variable lease payments. Where at the moment you are not aware about what would be the inflation over the next 10 years. That is the challenge. Right? You are not aware about the inflation or the CCPI value over the next 10 years. Then what do I do? So, at the inception, you consider the index would prevail at the current price. If the index is at the current price, what is the amount of the lease payments? There's no other assumption where you can make. No. You assume that variable payments are made based on the current index value for each year. Now, what will happen is, now let's say based on that you computed the value of the lease liability. So thereafter, when you move to year 1, what can happen? That index can be changed. In this case, it is mentioned that it's not changed, right? But let's assume if it is changed, then what will happen? At the end of year 1, you have to assume that index will prevail at the value at the end of year 1. Thereafter, what would be the next 9 payments are? Similarly, at the end of the second year, new value for the index, then you assume that index will prevail at the value at the end of year 2. So then what would be the next 8 payments are? So what you need to do is at the end of each year, you have to do a remeasurement for this variable liability component. Right? You have to do a remeasurement. Accordingly, you have to adjust your lease liability and the right of use the asset. So in this question, it's not required, but we discuss how to do that in our theory class. Okay, if it is a remeasurement, depending on the index change, So how are you going to adjust that in the financial statements? That you need to be aware, but not required in this situation. Right. Okay. As the extension option of the lease is not within the control of the lessee, the discretion is with for the lessor for the Vaunia property. Per paragraph B37 of SL-25 16, the extension option cannot be considered in the determination of the lease term. Accordingly, lease term is for how many years? Only 10 years. As the lease term is for 10 years, our incremental borrowing rate in this case, Vaunia property, only 10%. Right? As the extension option cannot be considered as part of the lease period. Accordingly, now we are going to calculate the lease liability value at the inception of the lease again. Now, here lease liability computation should include both fixed payments as well as what? Variable payments. Fixed payments as well as variable payments. What is the value of the fixed payments? How to calculate the value of the fixed payments? Lease term, remember how many years? 10 years. Now, out of this 10 years, again, if I draw the timeline for your understanding, okay, let's say these are the years 0, 1, 2, 3, 4, 5, 6, 7, 8, 9, and 10. And if you look at the lease payments are paid in advance again. So the first payment at the beginning of the year 1, that means time period 0. Second payment beginning of year 2, that means time period 1. So likewise, you made the payment. The last payment would be paid at the beginning of year 10, that means at the end of year 9. Out of this, first payment is already paid at the lease commencement date. So which means I am not going to take this into the lease liability computation. Right? So the lease liability computation should consider how many payments? 9 payments, 9 periods. So when it comes to these 9 payments, 9 periods, so the next payment is at the beginning of the second year. At the beginning of the second year means what? At the end of year 1. Last one, at the beginning of the 10th year, that means period number 9. So calculate the present value of these 9 payments, because you just need to compute the value of the fixed component, because the value of the variable component examiner has given. So you just need to compute the value of the fixed component. So yet again, 8 million per annum, that means each year 8 million. You can use the annuity formula to compute the present value of this 8 million payment, which has to be paid over the next 9 years. So use the same formula what I have mentioned, same formula in the sense what I have just written down over there. In this case, what is R and what is N? R is 10%. Incremental borrowing rate is 10%. Discounting factor is 10%. N is how many periods? 9 periods. Right? Based on that, if you apply this formula, what is the annuity factor that you get? This is the annuity factor that you get. Yes, you get that number, 5.7590. You multiply that by 8 million, then present value of the fixed lease payments are 8 million into 5.7590, 46,072,191. In this case, you have to consider the what? fixed component as well as the what? Variable component into the computation of the lease liability. So you have been given what is the value of the variable component. So here it's mentioned that present value of the variable lease components and the incremental borrowing rates at the date of signing of the respective lease agreements with and without considering the extension option are as follows. So in this case, what we need is actually the 𝐓𝐽𝐼𝐻 property, right? 𝐓𝐽𝐼𝐻 property, this is what we look at. So are you looking at 10 years or 20 years? We are looking at only 10 years because why? We are not going to take the extension into the lease term. So then we have to take 10 years. So 𝐓𝐽𝐼𝐻 property, 10 years lease term, what is the value of the variable component? 5,163,200. 5,163,200. You add that to the fixed component present value. Present value of the fixed component is 46 million. To that you add present value of the variable lease payments, 5,163,200. Then add these two together, right? When you add these two together, what is the total value? 51,235,391. This is the present value of the lease liability in terms of the what? 𝐓𝐽𝐼𝐻 location, right? Earlier we looked at what is the present value of the lease liability of the Jaffna location. How much? 58,121,948. Right? 58 million, and this one is 51 million. Have we answered to the question? No, only part of it. We still have not looked at what is the value of the right of use the asset. We estimated the value of the lease liability. So in the case of SLFRS 16 leases, from lessee's perspective, first of all you need to calculate the value of the lease liability. That we have done now. Thereafter, you need to derive the right of use the asset value. Now, when it comes to the right of use the asset value, how to derive that is this. This is done. Now I am moving here. Right of use the asset value, the starting point of the right of use the asset value is the value of the lease liability. Recognized at cost, measured at the amount of the lease liability. Sorry. So right of use asset measured at cost or recognized at cost, measured at the amount of the lease liability plus. Starting point of the right of use asset computation is the value of the lease liability. That plus few other things. Now for this particular question, all these things are not applicable, but I'll explain you what are the applicable things. Lease liability plus any initial direct cost incurred by the lessee, which equals to the, initial value of the lease liability we have taken. Then look at the second one. What is the second one? Lease payments made at or before the commencement. So what I am doing now? I am going to calculate the right of use the asset value. To compute the right of use the asset value, my starting point is the value of the lease liability that I have calculated now. To that, I have to add few more things. The first thing is, at the commencement date or before the commencement date, if I have paid anything, that has to be added. In this case, in both cases, at the commencement date, you have already made the first lease payment, isn't it? In the case of Jaffna property, 12 million. In case of 𝐓𝐽𝐼𝐻 property, 8 million. Those have been paid. So those are to be then what? Added. Those are to be added to the value of the lease liability to derive the right of use the asset. Not only that, lease liability value, then the lease payment made at or before the commencement, then the initial direct cost. Remember, it's mentioned that To enter into these lease agreements, you have to incur what? 1% as the lawyer fee from the first year fixed payment, 1%. Now, what is the Jaffna property first year fixed payment? 12 million. 1% of 12 million, how much? 120,000. Then similarly, 1% of fixed payment of the 𝐒𝐫𝐚𝐽𝐻 property for the first year. First year fixed payment is 8 million. 8 million into 1%, how much? 80,000. So 120,000 in case of the Jaffna property, legal fees, 80,000 in case of the 𝐒𝐫𝐚𝐽𝐻 property. So those two also added to the respective lease liabilities to derive the right of use the asset value. And third one, so the last one is not relevant here. Because of that, I'm going to touch upon, because if you can remember, fine. If you can't remember, so look at all these elements, right? Go back and look at go back and look at your tute, or else watch the lecture again. Right, okay, then let's go back. Right. Right of use the asset should be recognized for each of the contract at cost per paragraph 24 of SL-FRS 16. We should include the amount of initially measured value of the lease liability. Amounts paid in advance at commencement or before the commencement of the lease. Sometimes you make the payment before the commencement. Sometimes you make the payment at the commencement. In this case, at the commencement. And initial direct cost. Very simple. So lease liability, amount paid in advance at the commencement of the lease, and initial direct cost. So the opening point is lease liability value. In Jaffna property, we calculated 58,121,948. 𝐒𝐻 property, we calculated the value of the lease liability 51,235,391. Then advance payment, that is the first fixed payment made at the commencement date. In terms of the Jaffna property, 12 million. In terms of the 𝐒𝐻 property, 8 million. Add these things. Then legal fees, 1% of first year fixed payment. In terms of Jaffna property, 120,000. How do you get that? 12 million into 1%, 120,000. 𝐒𝐻 property, 8 million into 1%, 80,000. It's mentioned in the question, right? If I show you here, Mega expect to incur lawyer fees equal to 1% of first year's fixed lease payment, right? For each outlet at the time of signing the respective lease arrangements. And these lease arrangements are expected to be signed on 1st April 2026. 1st April 2026 means at the beginning of the year, because the year end is 31st March 2027. Right, then once you add 58 million, 121,948, 12 million and 120,000, what is the right of use the asset value in case of Jaffna property? 70,241,948, which is above the value of the lease liability, right? Similarly, 𝐒𝐻 property, once you add all these three things, 59,315,391, again above the value of the lease liability. Right, now the initial measurement is done. Initial measurement means these numbers, or what we discussed, the accounting treatment is as at when? At the commencement of the lease, at the beginning of the lease, at the beginning of the period, 1st April 2026. Then the question is what? How to account for these leases for the year ended 31st March 2027. Then you have to talk about the subsequent measurement of lease liability and the right of use the asset as well as what are you going to take into the profit and loss statement for the year ended 31st March 2027. You have to disclose, or you have discussed that as well. Right. Okay. Now with regard to right of use the asset. Remember, in case of Jaffna property, what is the lease term? 20 years. In terms of Vaunia property, lease term 10 years. What are we going to do with the right of use the asset? That right of use the asset value has to be what? Charged to the P&L over the lease term. What is the lease term? In case of Jaffna property, 20 years. So, what is the per annum depreciation then? What is the per annum depreciation? You can calculate per annum depreciation 70,241,948 divided by what? 20 over here. So the depreciation charge is how much? 70,241,948 divided by 20. So you get how much? 3,512,097. In case of Vaunia property, what is the lease term? Remember, there the lease term is only 10 years. So you get the right of use the asset, depreciate over the lease term. Now, what is the right of use the asset? So the value what is mentioned over here is incorrect. So the value has to be 59,315,391. That has to be divided by 10. Then per annum depreciation is 5,931,539. Okay. So this is, so the depreciation is getting charged to the P&L. Now, if you want to calculate what is the value of the right of use the asset at the end of year 1, that means on 31st March 2027, how do you get that? 70,241,948 minus the first year depreciation, 3,512,097. So you will get the value of the right of use the asset, value of the right of use the asset at the end of the first year. So this is the value of the right of use asset of the Jaffna property of the first year. This is the figure. Right? How did you get that? How did you get that? As mentioned, right of use the asset value 70 million minus this 3.5 million, right? So you get how much? 66.7 million, 66,729,851. Similarly, in terms of Vaunia property, how do you get the right of use the asset value at the end of the first year, 31st March 2027? 59.3 million minus first year depreciation, 5.9 million. So how much? You get the value as 53,383,852. Right of use the asset value minus first year depreciation. Very simple. That is at the statement of financial position. Right? Accordingly, lease liability balance and the right of use the asset balance as at 31st March 2027 should be presented in the financial statements as follows. Then you may have a question. What is the question on this particular point? What is that? You might have a question on this particular matter. What is that? This one. About the depreciation of Jaffna property. What it says? Building in Jaffna requires significant modification costing of 100 million. As a result, it is expected that it will take additional 6 months to open the outlet from the date of signing the lease agreement. Now, in terms of Vaunia property, no issue. Once you sign the lease agreement, immediately you start operations. So you depreciate the right of use the asset over 10-year period. No issue in terms of Vaunia property. But with regard to Jaffna property, You enter into the lease agreement on 1st April 2026, but as there's a modification work to be done by incurring 100 million worth of cost, you won't immediately start the operation. You start the operation in 6 months' time after signing the agreement. So my question to you is that can you immediately depreciate? Can you depreciate the right of use the asset for the first 6 months? So isn't it the depreciation limited to the last 6 months once you start the operation? No, this is right of use the asset. Okay, so you have the lease liability. Based on the value of the lease liability, you computed the right of use the asset. So the right of use the asset start depreciation from the commencement of the lease, right? Maybe this 100 million what you incur for the modification, let's say you need to incur 100 million for the modification. What's the double entry of that? You credit cash and debit the asset. That start getting depreciated from the date of the operation. But this is what? Right of use the asset. Right of use the asset depreciation should start from the lease commencement date. So that's why I have depreciated the right of use the asset of Jaffna property also over how many? Over the entire 1 year period. Over 20 years. So you have to take the entire depreciation per annum. Right? Hope you are clear with that. Right. So that is about the P&L numbers and the statement of financial position numbers in terms of the right of use the asset. Right? In terms of the right of use the asset. Then you have another component. What is that? Lease liability. On one side you have right of use the asset, on the other hand you have the lease liability. On lease liability, this is a financial liability. Okay, it's a financial liability. On the financial liability, you need to calculate what? Finance cost. How to calculate the finance cost? Now this lease liability, if you look at Jaffna property, lease liability is 58,121,948. Then what is the implicit interest rate of the lease here? The lease discounting rate. What is the discounting rate that we have used here? 20%. Then what you need to do is this lease liability. On this lease liability, you have to recognize the finance cost. How to recognize the finance cost? Very simple. Beginning of the year, value of the lease liability. This is at the beginning of the year 1, you have a lease liability of 58.1 million. 58.1 million. That into 20% is your finance cost. So what is the first year finance cost then? What is the first year finance cost? Here, 58,121,948 into 20%. How much? 11,624,389. This is also getting charged to where? P&L. Interest cost. P&L debit, lease liability credit. Depreciation double entry, P&L debit, right of use asset credit. Depreciation, P&L debit, right of use asset credit. Interest, P&L debit, lease liability credit. In case of 𝐓𝐫𝐚𝐽 property, do the same thing. What is the value of the lease liability at the beginning of the year? At the beginning of year 1. This is the year 1. No? At the beginning of the year, lease liability at the beginning of the year into the discount rate. So the lease liability 51,235,391. 55,235,391. And what is the incremental borrowing rate or the discount rate for the second property or the 𝐓𝐽𝐽 property? 10%. So you multiply beginning of the year lease liability value by discounting rate 10%. So because lease liability is a financial liability. If it is financial liability, you have recognized the finance cost. Okay. Into 10%. What is the value? 5,123,492. 539. That is also getting charged the P&L. So what will happen is, at the end of year 1, your lease liability value will increase with this finance cost. Now if you look at Jaffna property, 58 million plus 58.1 million plus 11.6 million. Here, 𝐓𝐻𝐼𝐴 property, 51.2 million is the initial value of the lease liability. To that, you need to add 5.1 million. So at the end of the year, your lease liability value would be as follows. Jaffna, 69.7 million, 69,746,338. 𝐓𝐻𝐼𝐴, 56,358,930. So that is actually the finance cost or the interest charge is getting added to the value of the lease liability, because the double entry is P&L debit, lease liability credit. Lease liability credit means this finance cost is getting added to the initial value of the lease liability. So the 58.1 million in Jaffna, 51.2 million in 𝐓𝐻𝐼𝐴. Right, so this is what we did. If I read it quickly, the respective right of use the asset should be depreciated over the lease period from the commencement of the respective leases as per the para 32 of SL-FRS 16. Accordingly, this is what I mentioned. Accordingly, even there's a delay in opening the outlet in Jaffna, the right of use the asset should be depreciated. Even though there's a delay in opening the store in Jaffna, the right of use the asset should be depreciated from the date of commencement of the lease. Right? The respective lease period for Jaffna and 𝐓𝐻𝐼𝐴 outlets should be 20 and 10 years. So Jaffna, it is 20 lease term, 𝐓𝐻𝐼𝐴 10 years. So you depreciate Jaffna right of use the asset over 20 years, 𝐓𝐻𝐼𝐴 over 10 years. The liability should be measured subsequently based on the paragraph 36 of SL-FRS 16, and the interest expense, finance cost, resulting from the liability should be charged to the P&L, right, that we discussed. Right. Then, I already told you, we have not taken the. Now, if you look at the variable lease payment over here, we have not taken the variable component of Jaffna location into the lease liability computation. So because of that, whatever the value, now you know at the end of the first year how much of revenue that this particular outlet generated. Out of that, you take 2%, and that amount you need to charge the P&L of the first year. So likewise, each year, revenue into 2%, you charge the P&L. That is simple and straightforward. Right? Then the other thing is, if you look at the 𝐓𝐻𝐼𝐴 property, I explained this before as well. If you look at the 𝐓𝐻𝐼𝐴 property, the variable component we take into the account, because that is depending on an index, that is depending on the inflation rate. So when you estimate in the value of the variable component at the beginning, we have not calculated that because examiner has given us the number. But practically what will happen is, now amount would vary each year depending on CCPI, but we don't know what would be the CCPI value. At the commencement, we assume that CCPI will remain at the value at the commencement. Based on that, what is the value of the variable component? You calculate, take the present value and take that into the lease liability computation. In that manner, right, with regard to 𝐓𝐻𝐼𝐴 property, we assume that CCPI will remain at the value of the commencement date, and based on that, we calculated what is the present value of the variable lease component, 5,163,200. We calculate. Now what will happen is, when you complete the first year at the end of each year, now what is the end of the first year? 31st March 2027, because this has been commenced on 1st April 2026. at the end of the first year, that is on 31st March 2027, what are you going to do is you have to look at, okay, what is the value of CCPI now? It can go up, it can come down. It will vary. Now, based on the first year number, then you assume that that first year number would be there for the next 9 years. Then you recalculate the value of that variable component. Then there's a difference. That difference, you need to adjust it to the lease liability and the right of use the asset. So this is called as remeasurement, which I discussed in the theory class. You have to refer that. Okay, this is the pilot paper. No? Your exam paper can include a remeasurement. Okay, here you don't need to do a remeasurement because why? Because why? Here it's mentioned, if you look at this statement, it is assumed that inflation rate will remain same throughout the year ending 31st March 2027. That means index has not been changed. But if the index has been changed, let's say it's mentioned that index has, initially the index value is this, now at the year end 31st March 2027 index is this. Then what you do? You have to do the remeasurement because you are asked to explain the accounting treatment as at 31st March 2027. Then you have to include the remeasurement entries as well. You have to do the remeasurement, right? That remeasured amount, you need to adjust your right of use the asset and the lease liability values. But that is not required here because the inflation rate has not been changed, or else CCPI index has not been changed. If it is changed, you have to incorporate the impact of remeasurement. Remember that. Since the variable lease payments of 𝐒𝐿𝐼 is depending on the inflation rate, the lease liability has to be remeasured. By discounting the revised lease payments when there's a change in lease payments due to the change in the inflation rate. This is what I mentioned. So you have to take the revised lease payment depending on the index change and discount it and calculate what is the value of the variable component now. However, as there will not be any changes of the inflation rate, the liability should not be remeasured as at 31st March 2027. However, in the current year, for the year end at 31st March 2027, inflation rate has not been changed. There's no inflation. So the index value is same. So that I'm not going to remeasure the lease liability, because what you do is you initially remeasure the liability. Then when you adjust, you can't just adjust the liability. No? You can't pass only one entry. Let's say because of this remeasurement, liability value has gone up. Let's assume index has gone up because of the inflation. Now the liability value has gone up. That means liability has to increase. So the credit entry goes to the liability. You can't just pass the credit entry. No? So then you have to debit that amount to the right of use the asset. So the remeasurement adjustments. So the remeasurement is measured by taking the value of the liability into account, the change in the value of the liability. But when you pass the entry, both liability and the right of use the asset is getting affected. So in my example, if the liability goes up, lease liability credit, right of use the asset debit. Okay, right. Right, so this we have looked at, right? Accordingly, lease liability balance and the right of use the asset balance as at 31st March 2027, that is at the reporting date, should be presented in the statement of financial position as follows. Right, we looked at this, right? Right, so that is actually the answer for the part A of question number 2. Part A of question number 2.